In the late 1990s, the world believed it was witnessing a telecommunications revolution. The internet was expanding at an unprecedented speed. Fiber optic cables were stretching across continents, and a company from Mississippi was quietly rising to become one of the most powerful corporations on Earth. Its name was WorldCom. Investors saw endless growth. Analysts praised its aggressive expansion. Employees believed they were building the backbone of the digital future. For a moment in history, WorldCom seemed unstoppable. A corporate success story fueled by ambition, technology, and Wall Street optimism. But beneath the surface, behind glossy earnings reports and soaring stock prices, something was deeply wrong. Hidden inside the company's accounting system was a massive deception. Billions of dollars in fake profits, carefully engineered to keep the illusion alive. What began as a bold business empire would soon unravel into one of the largest corporate frauds in history. This is the story of WorldCom, its meteoric rise, its breathtaking deception, and the whistleblowers who brought the empire crashing down. Let's break it down. The fall of a giant. In the summer of 2002, the American business world witnessed something that seemed almost impossible. The second largest long-distance telecommunications company in the United States, a corporation that handled half of all internet and email traffic flowing through the nation, a titan valued at over $100 billion at its peak, collapsed in spectacular fashion. WorldCom didn't just fail. It imploded under the weight of the largest accounting fraud in American history at that time, an $11 billion deception that would send shockwaves through Wall Street, devastate the lives of thousands of employees and investors, and fundamentally change how corporate America operates. This is the story of ambition without restraint, of numbers twisted to serve pride and greed, of whistleblowers ignored and truth suppressed, and ultimately of a few courageous individuals who risked everything to expose a lie that had grown too massive to contain. The WorldCom scandal represents more than just corporate malfeasance. It stands as a cautionary tale about what happens when the pursuit of growth becomes disconnected from reality, when leadership prioritizes stock prices over integrity, and when the pressure to meet Wall Street's expectations overrides fundamental honesty. This is the story of how an empire built on innovation and aggressive expansion crumbled because its foundation was built on fabricated numbers and false promises. The rise of an empire. To understand how WorldCom fell, we must first understand how spectacularly it rose. The company's story begins with Bernard Ebbers, a former milkman and basketball coach who seemed an unlikely candidate to build one of America's largest corporations. Yet Ebbers possessed something that would prove both his greatest asset and his ultimate downfall: an insatiable appetite for growth. Throughout the 1990s, WorldCom expanded through a relentless acquisition strategy, swallowing up smaller telecommunications companies and integrating them into an ever-growing empire. The strategy was breathtakingly aggressive. Ebbers understood that in the rapidly evolving world of telecommunications, size mattered. Larger networks meant more capacity, more customers, and more revenue. Each acquisition was financed largely through stock, which meant WorldCom's share price had to keep climbing to maintain the company's ability to make deals. It was a strategy that fed on itself, requiring constant growth to sustain growth. The crown jewel came in 1998 when WorldCom acquired MCI Communications for $37 billion. MCI was a giant in its own right, a company with revenues 2.5 times larger than WorldCom's. The merger created a telecommunications colossus. By 2001, WorldCom was handling half of all internet and email traffic in the United States. Bernie Ebbers, once a humble milkman, was now worth an estimated $1.4 billion, ranked as the 174th richest American on the Forbes 400 list. He had become one of the highest-paid executives in the country, living a life of extraordinary wealth and influence. But this empire was more fragile than it appeared. Its foundation rested on a single critical assumption: that WorldCom's stock price would continue its upward trajectory, enabling the company to keep acquiring, keep growing, and keep satisfying Wall Street's insatiable demand for double-digit expansion. Cracks in the foundation. Early 1999 marked the beginning of the end. WorldCom's revenue growth began to slow, and with it, the stock price started to decline. The telecommunications industry was experiencing a massive overcorrection. Throughout the late 90s, companies had invested heavily in network infrastructure, betting on explosive internet growth. Those expectations never materialized. The result was a vast oversupply of telecommunications networks, putting downward pressure on prices and revenues. Then came another blow. WorldCom's proposed merger with Sprint Corporation was blocked by regulators on antitrust grounds. Bernie Ebbers and his senior management team faced a crisis. Wall Street expected continued robust growth, but the reality inside the company told a different story. Revenues were stagnating. Real profits were turning into losses. For Ebbers, the stakes were personal. He had $400 million in loans backed by his WorldCom stock. If the stock price fell too far, he would face margin calls that could wipe out his fortune. The pressure to maintain the illusion of success was immense, and the temptation to manipulate the numbers became irresistible. The architect and his design. Scott Sullivan was WorldCom's chief financial officer, brilliant and meticulous. He was about to use his accounting knowledge to construct one of the most elaborate frauds in corporate history. The scheme was deceptively simple. WorldCom paid billions to other telecommunications companies for network access. These line costs were operating expenses that should have reduced reported profits. Sullivan decided to reclassify these operating expenses as capital expenditures, moving them from the income statement to the balance sheet, making them disappear from quarterly earnings reports. Sullivan directed controller David Myers to make false entries. Together with General Accounting Director Buford Yates and Head of Property Mark Abide, they created a fabricated term, prepaid capacity. It wasn't recognized under generally accepted accounting principles. It was simply a label designed to obscure reality. Lower-level employees like Betty Vinson processed these entries without understanding their purpose, following orders without documentation. The scale was staggering. By reclassifying line costs and manipulating reserves, WorldCom created $3.85 billion in false profits. Without these fraudulent entries, WorldCom's reported $130 million profit in the first quarter of 2002 would have been a $395 million loss. The first warning. Not everyone at WorldCom was willing to go along with the deception. In December 2000, a financial analyst named Kim Amai was given an order that immediately raised red flags. Amai, who had come to WorldCom through the MCI merger, was told to allocate labor for capital projects in WorldCom's Network Systems division as capital expenditure rather than operating costs. By Amai's estimate, the directive would have affected at least $35 million in capital spending. Amai recognized what he was being asked to do. This wasn't creative accounting or aggressive interpretation of the rules. This was fraud, potentially even tax fraud. He refused to comply and pressed his concerns up the chain of command, notifying an assistant to WorldCom's chief operating officer. Within 24 hours, the directive was reversed. Someone higher up had decided not to implement the order, at least not through Amai. But Amai's reward for his integrity was swift and punishing. He was reprimanded by his immediate superiors for making waves, for questioning orders, for being difficult. 3 months later, in March 2001, he was laid off. His employment at WorldCom was over. Amai had tried to do the right thing, and it cost him his job. For more than a year, his warning went unheeded. WorldCom continued its fraudulent practices, the false entries piled up, and the gap between reality and reported results grew wider. Amai, now unemployed and watching from the outside, knew something was deeply wrong at WorldCom. In May 2002, he shared his story with Fort Worth Weekly, a local publication. He told them about the directive he'd been given, about his concerns regarding MCI's spending habits that had persisted even after WorldCom's takeover, about vendors billing WorldCom for exorbitant amounts. It was a small article in a local weekly, easily overlooked in the vast landscape of business journalism. But that article would prove to be the spark that ignited the discovery of WorldCom's massive fraud. Sometimes the most important revelations come not from major investigations or regulatory oversight, but from a single person who refuses to be silent about what they've witnessed. Internal investigation. Glenn Smith, an internal audit manager at WorldCom's headquarters in Clinton, Mississippi, read Kim Emi's interview. He brought the article to his boss, Cynthia Cooper, WorldCom's vice president of internal audit. Cooper was known for her thoroughness and unwillingness to back down. Smith suggested beginning the capital expenditure audit early. Cooper agreed, and in late May 2002, the audit began. Almost immediately, they encountered something strange. Corporate Finance Director Sanjeev Sethi mentioned prepaid capacity. Cooper had never heard the term. When questioned, Sethi claimed ignorance despite his role approving capital spending. Eugene Morse began searching the accounting system and found unusual movements of large amounts between accounts. The audit team discovered funds moving from WorldCom's income statement to its balance sheet in irregular patterns that made no accounting sense. As resistance emerged from David Myers, Cooper made a fateful decision. The audit team would work at night, conducting their investigation in darkness, while the rest of WorldCom slept. On June 10th, working in darkened offices, they discovered additional prepaid capacity entries showing large transfers totaling billions of dollars. Cooper knew she was uncovering something that would shake WorldCom to its foundations. The web unravels. Scott Sullivan requested a meeting with Cynthia Cooper, wanting to review her audit projects. When questioned about prepaid capacity entries, Sullivan offered explanations about line costs and fixed expenses. Then came his real objective. He requested Cooper postpone the audit until the third quarter. Cooper wasn't persuaded. She contacted Max Bobbitt, chairman of the audit committee, who directed her to consult with KPMG, WorldCom's external auditor. Cooper's team had identified 28 prepaid capacity entries. Their analysis revealed that without these fraudulent entries, WorldCom's reported profit would have been a massive loss. Cooper interviewed the accountants who made the entries. Betty Vinson admitted processing them without understanding their purpose or seeing documentation. David Myers finally acknowledged the truth. There was no support for the entries. They had been booked based on what we thought the margins should be, without accounting standards justification. Kenny Avery confirmed that no generally accepted accounting principles allowed for capitalizing line costs. An audit committee meeting was scheduled for June 20th. By then, Cooper's team had discovered over $3 billion in questionable transfers. Sullivan tried arguing the entries were justified under the matching principle. The audit committee demanded supporting documentation. Sullivan couldn't provide it because it didn't exist. The reckoning. The final count was devastating. 49 prepaid capacity entries totaling $3.8 billion in fraudulent transfers. Some entries were literally labeled SS entry, bearing Scott Sullivan's fingerprints. At a subsequent audit committee meeting, Sullivan presented a white paper attempting one final explanation. But the game was over. The audit committee and KPMG concluded the amounts had been transferred solely to meet Wall Street targets. Arthur Andersen withdrew its audit opinion. The board demanded resignations. On June 25, 2002, WorldCom's board accepted David Myers' resignation and terminated Scott Sullivan. That same day, WorldCom executives briefed the Securities and Exchange Commission. The public disclosure followed immediately. WorldCom announced it had overstated income by over $3.8 billion. The reaction was catastrophic. WorldCom's stock went into freefall. The company announced plans to lay off 17,000 employees. Investors watched $180 billion in market value evaporate. On July 21st, WorldCom filed for bankruptcy. The SEC filed civil fraud charges, alleging the scheme had been directed and approved by senior management, pointing clearly towards CEO Bernard Ebbers. Justice and consequences. The question dominating the trial was simple. What did Bernie Ebbers know? Scott Sullivan later confirmed that Ebbers knew about the capitalization of line costs. Internal communications showed Ebbers receiving information inconsistent with the rosy picture he painted publicly. In 2005, a jury found Bernard Ebbers guilty of fraud, conspiracy, and filing false documents. The judge sentenced him to 25 years in prison. For a man 63 years old, it was effectively a life sentence. Scott Sullivan, who became the government's star witness, received 5 years and forfeited his $11 million mansion. David Myers, first to plead guilty, was sentenced to 1 year and 1 day, the extra day making him eligible for early release. Ebbers served 13 years before compassionate release in December 2019 due to legal blindness, dementia, and severe weight loss. On February 2, 2020, Bernie Ebbers died. The empire builder, who had once been worth $1.4 billion, left behind a legacy defined not by the telecommunications giant he built, but by the massive fraud he perpetrated. Legacy and lessons. The WorldCom scandal shook confidence in corporate America at a time already damaged by Enron's collapse. In July 2002, President George W. Bush signed the Sarbanes-Oxley Act into law, representing the most significant changes to securities laws since 1934. The act imposed strict new rules on corporate governance, required CEOs and CFOs to personally certify financial statements, and created severe penalties for corporate fraud. WorldCom emerged from bankruptcy in 2004, reclaiming the MCI name. In January 2006, Verizon Communications acquired MCI, finally bringing the WorldCom story to its conclusion. The brand that once represented telecommunications dominance was absorbed and ceased to exist. Cynthia Cooper became one of Time magazine's Persons of the Year in 2002, and later wrote extraordinary circumstances about her experience. Kim Emig demonstrated that individual integrity matters even when consequences are painful. The WorldCom scandal reminds us that no company is too big to fail when built on lies. It teaches us that growth pursued without ethics is merely postponement of inevitable collapse. And it shows us that the courage of a few individuals can bring down even the most elaborate deceptions. $11 billion in fraudulent accounting, $180 billion in destroyed investor value, 17,000 jobs lost, prison sentences, and ultimately comprehensive reform that continues shaping American business more than 2 decades later. This is the legacy of WorldCom, a cautionary tale that remains as relevant today as in that summer of 2002, when the telecommunications giant fell, and the world learned just how far ambition without integrity can take us before the reckoning comes. WorldCom's collapse marked more than the downfall of a single corporation. It exposed the fragile trust that underpins modern capitalism, the belief that financial statements are honest, that leaders act responsibly, and that growth is real. When that trust shattered, billions of dollars vanished, thousands of employees lost their livelihoods, and investors watched their savings disappear. Yet from the wreckage came change. New laws were written, corporate oversight tightened, and the role of whistleblowers gained global recognition. The WorldCom scandal became a warning etched into business history, a reminder that unchecked ambition, secrecy, and pressure to meet expectations can destroy even the most powerful empires. Today, in an age of tech giants, crypto startups, and billion-dollar unicorns, the lessons of WorldCom remain painfully relevant. Behind every financial report and every corporate success story lies a question that must always be asked. Is it real, or is it just another illusion? Because as WorldCom proved, the biggest lies in history are often written in the smallest numbers.